Hello everyone. It's been a while since I made one of these videos. It's been quite a busy last few months, so sorry about that. But it is the end of 2019, and it's probably a good time to reflect a little bit on what happened during the course of this year and kind of what we're going to see in the next 6 months to a year and maybe even longer. Well, no surprise to anyone, 2019 was a tough year. Tough year for the LNG business overall. We saw prices actually crater. Spot, if you look at the spot price as an indicator of what prices are, spot prices have really dropped dramatically over the last probably 12 to 18 months. We have seen very few long-term deals actually getting signed because obviously in this marketplace it's very difficult to convince a consumer that a long-term deal is a good deal, because when short-term prices are so low, it's tempting us to buy on the short term. We have seen a surprising number of projects being sanctioned, probably a bit more than I would have expected. Obviously, some of them were not unexpected. Mozambique was not unexpected. The expansion in Yamal, which has been an incredible success, was not unexpected. But Venture Global in the US, yeah, that was probably a little bit of a surprise. There's still a lot of skepticism out there whether that is going to really work out as good as everybody thinks it is. It's really hard to know what their secret sauce is. They claim they have a secret sauce that's going to revolutionize the way projects are built, and that's why they can offer an incredibly low price. I think it remains to be seen whether that really does exist. And unfortunately, or fortunately, we won't know for another 2-3 years down the road as the project gets built. And if it's on track, great. But if the project costs start escalating more than their budget, who actually is left holding that hot potato? Is it the company? Is it the off-takers? Is it the engineering companies? But I understand the engineering companies don't really have a wrap insurance around that project. So that's a risky one in my view. No surprise, I think there was the American projects that were the most vocal. Tellurian, probably maybe a little bit of Next Decade, some of the other Venture Globals, Port Arthur. There's a few of those that were expecting to also get to FID this year. I think it was probably a bit optimistic. They had to kind of hype up to the marketplace, and they did. But we're going to see them in a bit of trouble now. I see the Canadian projects, really, apart from Shell Canada, which it remains to be seen how that's going to work out. There's going to be no other projects in Canada. I don't know about the East, if that's actually going to work. It's still hard to believe it will, especially when Canada is having a lot of political trouble right now. So what we have seen basically kind of is that we did see a record year for project FID, final investment decisions. But at the same time, it could have been a lot more if the market had done what everybody expected to do. But the market didn't. We saw spot prices go up. We saw the difference between the spot price and spot prices go down, sorry. And we saw the differences between the long term and the spot price increasingly widened. And that's probably very simple, of course. You're not going to see that difference if oil prices stay high, and a lot of the long term is still linked to oil price. So the long term prices of LNG to the marketplace, which are linked to oil prices, are still high, while the short term, which truly does probably reflect supply demand fundamentals, and you see that prices come down quite a bit. So let's talk a little bit about that supply demand fundamentals and what really happened. There was a really good analysis done by the Oxford Energy Institute a few months ago that showed a graph that compared incremental supply with incremental demand on a quarterly by quarterly basis over the last 18 months. And that showed very clearly that every quarter for the last year and a half, we have seen more incremental supply enter the market than incremental demand increase in the market. And of course, as supply goes up and demand doesn't go up as fast, then we're going to see a supply overhang. And when you have a supply overhang, the market is going to react by lowering prices. Initially, of course, the market was hoping this is a short-term thing, and they started filling up all the tanks. Obviously, that's a rational thing to do. But now the tanks are full. Ships cannot unload. I understand in Europe it's a big problem of the tanks, all the receiving terminals are totally full. And so we have a situation where the ships cannot unload. Ships cannot unload, obviously, they are forced to stay in the water. And unfortunately, LNG is a commodity that actually loses volume the longer you keep it from being used. Modern day ships can go to like 0.15% loss a day, but the older ships can maybe have 0.25% a day. So every 4 days, you lose 1% of your cargo. Every 40 days, you lose 10%. And if a cargo is worth $50 million, then suddenly you've lost $5 million in a month and a bit. Not a healthy situation. So of course the market has done what the market will do, which is try to convince the suppliers that they shouldn't supply as much, kind of bring things back to balance. But suppliers of LNG don't like to do that. They like their plants to run at full capacity all the time. And they're going to keep on pumping that gas out and liquefying that gas, and they're going to push the problem to the customers. So what happened with the customers? Well, we have a China year-on-year growth, which was year-on-year growth for the last few years, that has suddenly started slowing down. I think I read somewhere that the year-on-year for the last couple of months was 10% decrease, which is a lot considering that China was on track to be the second or the third largest LNG market in the world in the near term, and probably first largest market in the longer term. So we saw big demand growth areas such as China slow down. We saw generally around the world people getting a little bit nervous about the economic situation and slowing down manufacturing. We saw kind of a backlash against gas, which was the most surprising thing of the year. Really, gas became, the clean transitional fuel to the fuel that people are suddenly afraid that it's going to be this big polluting fossil fuel. Well, it is a fossil fuel, of course, but compared to all the other fossil fuels, it is a fantastic improvement for the environment. And again, I think the industry has not done a very good job of convincing the general public that gas is really the cleanest of all the fossil fuels. So this backlash against gas has kind of shown itself in surprising ways. We have actually seen coal increase in China. I think the China increase of coal could be, of course, related to the economic slowdown, so the incentive to go use a cheaper domestic gas. But at the same time, gas has lost a lot of its halo, and the industry didn't do anything about it. We didn't try to regain that public relations, advantage that we had over other fuels, and that is really sad. Yet again, it's an opportunity for the industry to kind of re-establish itself to the populace, and it didn't. It let the population decide itself what the industry is, and we are suffering a little bit of a backlash for that now. And I'm kind of afraid of what's going to happen down the road, because people, obviously, renewables are growing very rapidly, but gas is very important as a backup fuel for the renewables. And are we still going to see gas have that enviable position as being that backup fuel for renewables? It's hard to say. So kind of back to the situation, we saw supply increase with a lot of new projects that were sanctioned 4 or 5 years ago coming online. And we saw demand kind of falter in places like China, and actually decrease in China and falter in a lot of other places. So that was a mix to show, that obviously we're going to start seeing a price impact. Most of the gas in the world is still sold on long-term prices, so the customers can't really change the long-term prices, especially when the long-term prices are linked to oil. And so we saw the spot market crash. Now, a rational customer is going to say, why do I want to pay, $3, $4, $5 more, $8 more, which could be double the price of the gas on my long-term contract than I can literally get on the spot market today? So there's going to be a lot of tension between the buyers and the sellers. The buyers are going to say, hey, I don't want any more gas. Slow it down, guys. And the suppliers are going to say, hey, tough. You have a contract, you got to take it. And that's not a recipe for a good long-term relationship. And I see a lot more litigation, a lot more price reopeners, and a lot of countries coming out and saying, hey, too bad. We're going to change our deal. And that's going to really put a lot of suppliers in a bit of a fix. So that is actually a thing that we need to watch out for. We're also going to see a slowdown of final investment decisions next year in 2020. Why? Because, this is not a great time to be convincing a buyer that they need to sign expensive long-term oil-linked deals, especially oil-linked deals, because oil prices are high. and spotted gas price is low. So why would you want to still sign an oil-linked deal? And we can see the implication of that. I read last week that Qatar is now offering co-gas 10.8% slope. Unheard of. This is the same Qatar that was 5 years ago trying to convince the world that gas should be at a higher than oil parity slope, above 16%. And now they're offering a 10% slope, 10.8% slope. That means in today's gas price of $65, $63, or oil price of $63, co-gas is being offered from Qatar, maybe a price of around, $6 to $7. So a massive discount and not that much difference than the spot price. So that's what we're going to see. We're going to see discounting by the legacy suppliers to try on the new contracts to try to control and keep their market share. That's obviously tough for the newer projects trying to get out there in the world. I think Mozambique obviously got there in the right time, but other projects are going to suffer. Those trading companies whose business model is based on buy low, sell high, are really having a tough time if they buy high, sell low, which is kind of the situation. The trading companies are not going to be out there as eager to sign long-term expensive gas purchase contracts. And the end user is going to say, hey, I just want to buy on the spot market. It's a dangerous thing to do, of course, because the spot market can turn. It can turn very, very quickly. And in fact, what is going to happen in 2021, 22, not 2020 now. 2020 is going to be a tough year because there's still going to be incremental new supply coming from the US. But 21, 22, 23, we're going to see that new supply dry up. We're not going to see a lot of new projects coming online. And we're still going to see demand growth, especially because of the low price we see today. We're going to see a lot more people enter the market in the future. If I was a gas utility in Asia and I see how low the gas price is, I'm saying, hey, maybe I'll build a gas-fired power station next year instead of a coal-fired power station. So that low price response is going to happen. And it's very exciting when it does, of course. And that is going to actually increase prices. But at that point, there's going to be very little new supply. So the projects that are hoping to take final investment decision in the next few months are not going to happen, in my view, especially if they are very, very large projects. The US Tellurians and the next decade, they are 15, 20 million tons. There is no way I see that these projects can get to final investment decision or get sanctioned. There is not that many customers out there looking for that volume. And if they're looking for that volume, they don't want to sign it in long-term expensive gas anyway. So we really have to think about gas being kind of in the near term, the price dropping, and how are we going to appeal to the customer? What is going to differentiate project A versus project B? Of course, I would say Texas LNG is differentiated because we have this very, interesting position of being a relatively small project, 2 million tons per train, 4 million tons total, simple technology, and, hopefully cheap American gas. But we're not here to talk about Texas LNG. We're here to talk about the market. So I see 2020 as being a tough year for new projects. I see 2020 as a year of still low prices. And then towards the end of 2020, 2021, 2022, we're going to start seeing prices rise quite a bit, especially if oil prices stay high, because the incremental supply is not going to be there. So the buyers who are smart should actually think of locking in some of these great price environment, terms right now and actually signing up longer term deals. So we're going to see how that all works out. The projects that have, promised project sanction next year, early next year, are going to have a tough time, especially if they're funded by private equity and fickle investors, because these investors have given money or will give money to the projects based on certain milestones. And these milestones are typically based on signing long-term deals. If the long-term deals are not being signed, the milestones are not being reached, the money is going to dry up. We're going to see a lot of blood. So the guys with a lot of burn rate, the guys who are spending a lot of money in project development, they're going to be in big trouble. They're going to have to get rid of people and cut down their costs dramatically. The heyday of spending, like drunken sailors, I think that's going to be very much over. We're entering into a commodity price environment, a highly competitive industry. A lot of new projects around the world are being looked at right now. You have to be competitive. We have government actors such as Qatar and Russia who have the ability to obviously charge whatever they want for their gas. Qatar has rich gas, so it can actually sell gas, LNG, at a zero price because they'll make up their money from the NGL liquids. We have Russia, which is politically very driven to increase its market share. And private companies will have to offer something different to beat these very large government-owned actors. So the next few months are going to be interesting. Watch this space. I think that definitely, we need to work on the reputation of natural gas. We have let that slip. Bring natural gas to its correct position of being the transition fuel, low, very, very low carbon, very, very clean fossil fuel that it is. We can't be complacent about that. We have been. We need to, be wary of projects that are burning too much money today to try to get themselves, in front of the market, because they have shown that they cannot control their cost. And when you cannot control cost in a commodity price environment, it's going to be hard to make your project work. And we need to just be able to continue to work on making sure that the projects do come online on time and on budget. Have a great, great festival season. Have a great new year, and we'll see you in the new year. Bye.